What people miss with gold is that it is a bit different. It's an ancient monetary asset. Good news for gold investors is often bad news for pretty much everybody else. When gold starts running, it's not just a new hot sector, it's a smoke signal for something bigger, right? And it shouldn't be a surprise to anybody given the tectonic geopolitical shifts that we've seen since 2020 and 2016. If you want to go deeper, that gold is now becoming incredibly favorable.
Jay Martin, host of the Jay Martin Show, as well as host of the Vancouver Resources Investment Conference. It's a true pleasure to host you on Palisades Gold Radio today.
I'm happy to be here, Stijn.
Excellent, Jay. Really excited for this conversation. Of course, normally on the other side of the desk, so especially excited to pick your brain today. Would love to get started talking gold for a second. Of course, we've seen an incredible bull run in the metal, up over 55% year to date. However, we're seeing some mixed signals from the analysts. Some are calling for a blow off top, one last big push higher, while others think we might be in a structural trend shift. Gold continuously going higher for a long-term period. I would love to hear from your perspective, Jay, where we are within the larger cycle for gold.
Well, I think the way you need to answer that question is get super clear on what you think the bedrock of the gold thesis is right now. And you could go a handful of different directions with that. Where I choose to go is you look more recently at the 2022, 2023 central bank gold buying. This was the initial major buyer at the front end of this current market, right? And they started acquiring physical gold and are still acquiring physical gold for two primary reasons. And those reasons are that they believed the US dollar would be worth less than it is today in the future. It will be worth less than it is today. Therefore, it's not the best storeholder value. And number two, the United States geopolitical policy will be less predictable than it used to be, right? Look at the confiscation of treasuries and this behavior. As long as those two assumptions still hold water, the gold thesis is very much still intact. But the confusion people have about the gold market is that they often categorize this as just the next asset rally. And maybe they've made some money in a real estate rally, in the cannabis rally, in the crypto rally, in the AI rally. And they think now it's just gold's turn. It's just the next asset in the lineup. What people miss with gold is that it is a bit different. It's an ancient monetary asset. Good news for gold investors is often bad news for pretty much everybody else. When gold starts running, it's not just a new hot sector, it's a smoke signal for something bigger, right? And it shouldn't be a surprise to anybody given the tectonic geopolitical shifts that we've seen since 2020 and 2016. If you want to go deeper, that gold is now becoming incredibly favorable, with the longest term, slowest, and most conservative money being central banks and major institutions. A lot of retail investors are still calling this the debasement trade, which I think is emblematic of how they're thinking about this. It's a trade, right? But as you know, the mechanics of a trade are such that you have cash, you trade that for an asset that's undervalued. When that asset appreciates, you trade it back for cash. That's how that works. But applying that lens to the debasement trade in relation to gold doesn't make any sense, because you have the asset being cash, you trade that for gold. But if the reason for your trading for gold was debasement of the fiat currency, what's going to make you go back to that debased fiat currency? Like, the second half of the trade won't materialize. And so I think that truth will come out, and that realization and understanding will just occur naturally to a lot of investors who presently think they're in a trade. But as the train keeps moving, they'll realize this is a bit different. And and so, analysts, investors who are looking at the gold price or the gold equities and thinking it's getting a bit hot, it's getting a bit pricey, it's getting a bit popular, and they think therefore we must be near the top. I'll tell you right now, Stijn, that is a direct consequence of the PTSD that gold investors still have from the last 15 years. They've completely forgotten what a good market feels like because it's been so long. Not only was gold not in favor, gold's been hated for over a decade. you were called a fool for investing in gold. So that's the environment that we're all used to. So any favor whatsoever by anybody, mainstream or generalist, of course, feels completely obscure and crazy because we're not used to it. It's just been so long. But this is what the early stages of a good market begin to feel like, right? But I think gold is still early innings because of how misunderstood it is, even by some of the generalists that are buying it, and quite frankly, by how few generalists are buying it. You know, there's some on the margin, and we're ultra sensitive to that because we're in the circle, so we see it first. But, you know, I'm in a lot of investment groups, many of which are not related to precious metals at all, and you'd be shocked at how infrequently gold is even mentioned as an idea. I mean, people still just chuck money at the QQQ like it's the most obvious thing anybody should do with their cash, right? And so we're early innings.
Incredibly interesting to hear that, Jay. And of course, a way to track, you know, generalist investor interest is ETF inflows. And what I always find interesting is we've only seen a couple of months of net positive inflows, and they still seem to be relatively modest. And people are already calling for, you know, generalist investors already on top of gold. And this might be the end of the bull run.
You're absolutely right. And it's only been a couple of months. And I think all those outflows that we saw, even as the gold price was running, was people who got trapped in that, what they considered to be a trade back in 2022. They got in when it was kind of frothy and hot at the peak of the everything bubble that hit precious metals too. And then they got trapped for 2 years. And this is their first option of liquidity to get out. And so we're seeing a lot of people exit an asset they've been trying to get out of for a long time. There's a bit of recycling that's got to occur in that scenario.
Understood. So not a debasement trade. Would it perhaps then fit into a thesis of remonetization, of gold taking up another, you know, important spot in geopolitics?
Yeah, I think so. I mean, gold is it's the asset you own when you don't know what's around the corner, right? If there's a major shift happening in the marketplace and you can kind of see what's occurring, you might get visibility on where the puck's going next, and you can position yourself accordingly. It's my take at this point that we are exiting a 40-year geopolitical stage, being the era of globalization. My entire life has been the era of increased access to a wider variety of cheaper and cheaper goods because the global marketplace became more seamless. If you had the cash or the credit, you could buy whatever you wanted from whoever had it. That era is over. I'm highly convicted on that. What happens next? Far less predictable. It's not going to be fast. It's not going to be easy to predict. It's not going to happen all at once. It's a big unknown for everybody, right? And you can track the variety of geopolitical alliances and new adversarial relationships that are budding daily to give you evidence that it's very tough to understand what that geopolitical chessboard is going to look like in as short of a time period as just 5 years. When the world's moving so quickly into the unknown, gold is the ideal asset to own because it's the only one that does not have any counterparty risk and has the longest track record of retaining purchasing power. And that's just the Lindy principle, right? The longer the relevant historic lifespan of anything, that's the indicator of its future lifespan, right? So you can apply that to assets, to technology, like, you know, books are great technology, right? Been around for thousands of years. I have confidence, despite iPads and e-readers, books are going to be around for another couple thousand years. They've done quite well thus far, right? Where a technology that's been around for 20 years, I'm far less certain on its 100-year outlook, if that makes sense. That's the Lindy principle, quick and dirty. But gold's got 5,000 years of recorded history, and the evidence of its relevancy today, again, back to central bank gold buying, they don't know what boogeyman. We've been hit by a haymaker every year this decade, right? Like 2020, 2021, it was something new. We're only halfway through, you know, and whether it's a regional conflict, global economic shutdown, civil unrest that's spread through capitals of major countries, every year has been very, very volatile. We're only halfway through this transition decade. And so that's the life raft. It's smart to sit on. It's as liquid as US dollars. People might push back on that, but it's a global market. There's always a buyer for gold. So it's that option on liquidity without the counterparty risk. And that's why it's the asset of the day for sure.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Well understood, Jay. And of course, beginning of this year, we've seen a lot of reports of gold flying en masse to the United States, supposedly into the COMEX, the commodity exchange there in New York, and leaving through a mystery buyer that seemed to be unwilling or unable to buy on any other exchange. Who do you think was behind that?
Oh man, your guess is as good as mine, Stijn. I don't know. I would say that it's right in line with many of the efforts to covertly or not covertly secure an increasingly growing list of critical metals, right? And where that gold ended up, I wish I knew, right? But I don't really need to know. I can mimic what's interesting about that is that we're seeing major institutions, we're seeing major technology companies, and now governments begin to mimic my investment strategy, right? Probably your investment strategy, Rick Rule's investment strategy, right? One of exchanging fiat currency for hard assets, right? Someone's doing it in a major way in the gold sector. Many institutions are, many central banks are, but it's also not limited to only gold, right? If you look at the equity deals the US government's done in the last 6 months, it's like almost every week there's a new multi-billion-dollar equity deal done between the government or a department of the government into what is often an extraction company, right? A 15% stake in MP Materials, that's a mining company by the Department of Defense, now their biggest shareholder. 5% in US Antimony, 10% in Lithium Americas, 10% in Trilogy Metals. These are all mining companies, and these are equity deals done by the US government. And there's a few ways to look at that, but I think the most important way, or one interesting way, is that we're seeing the issuer of the currency exchanging that currency for hard asset interest, right? Which is what we've been doing for a minute. So it's validating. It should be validating, right? Yeah, I don't know who the gold buyer is. And there's a lot of, I imagine right now, there's a lot more covert gold deals going on than we know about, right? But that's just, it's a symptom of the bigger game that's being played right now.
And it also seems like an interesting step away from a fully free market policy towards a more, government interventional system.
100%. And I completely agree with you. This is when people see big developments like this happen, whether it's a string of equity deals, whether it's the 10% stake in Intel or the golden share in US Steel and the Nippon Steel merger, this is equity interest in major corporations by the US government. That is the definition of state capitalism. And people don't like to hear that, and I understand why. As distasteful as we may find the public sector becoming involved in our private business, nobody cares how we think or how we feel about that, right? At the government level. That's the change that's happening, like it or not. I'm a small business entrepreneur. I'm a free market guy. I prefer the government out of my business. I think the government in private business is like somebody trying to land an airplane with a sledgehammer. Like, it's rarely ever going to work out, right? They're going to swing at things. They don't know what they're doing. They swing way too hard and overcorrect, best case scenario. But none of that matters because this is what's happening and the trajectory is set. You look at this string of deals, don't make the mistake of thinking, oh, that's just a little bit of subsidy for some important industries right now. There's now 60 metals on the critical metals list in the US, up from 25 in 2018. We've almost doubled it, right? At this trajectory, we'll have the whole periodic table on the critical metals list in a few years, right? And the US government's not going to wait around for what they think will take too long to let the private market sort out the national interest, which is control of these key minerals. But more importantly, this state capitalism policy is new to us in the West, and we find it weird and a bit uncomfortable, but it's not new to the United States' biggest competitor. And if you step back and look at the globe as a marketplace and all the countries in it as corporations, you've got the USA Corporation, its biggest competitor being China Corporation. Well, state capitalism has been the policy that lifted China Corporation from a nation of effectively poor rice farmers in the 90s to the top contender for global supremacy and a world leader in many advanced technologies. So if you're at the helm of the United States watching this unfold, of course, you're going to question what part of that policy or those policies should we be mimicking? Because clearly it's working very well, right? And that's sort of like, people make the mistake of still labeling China as a communist country, but it hasn't been since Chairman Mao died in 1973. It's been this weird hybrid, right? The Deng Xiaoping era, where it doesn't matter if it's a black cat or a white cat. As long as that cat catches mice, we like the cat, right? That was what he said. And what he meant was that let's focus on the results, not the policy. I don't care if it's a socialist policy or a capitalist policy. If it gets results, we like the policy. Now, there's far more centralized control, obviously, in China than I'd ever want to see here in the West, but we're adopting big pieces of it. There's two sides to this coin, Stijn. One would be that any free market entrepreneur is going to be concerned with this trend, and I totally empathize with that. But it's happening whether we like it or not. So the upside to it would be that there's a new activist investor at the table in the mining industry. This is a big shift for a couple of reasons. We have demonized and vilified this industry in the West for the last 15 years. In Canada, not since the Harper administration, has this sector gotten to any level whatsoever. And as a consequence, it's been a very tough business to be in. It's been starved of capital. It's been overregulated and overtaxed. And we've fallen way behind as a consequence. This new activist investor being the United States government in the US, but Canada's right behind following suit with this new budget outlining 11 natural resource projects that's going to support in some way. This party comes to the table with very deep pockets to move projects forward, but also adjust regulation where required. Like the Trilogy Metals deal in Alaska. This is a critical metals company based in Vancouver, British Columbia, but the asset they would like to mine is in Alaska. And the problem with it, the geology is very good, but the access has been absent. There's no road up to their asset. It's fly-in access only, which made it uneconomic. And the Biden administration blocked that access road. It was called the Ambler Road, multi-billion-dollar project if it were to be built. Right after the United States government wrote their $35 million check into Trilogy Metals, the next move was to coordinate the Bureau of Land Management to get that road built. So this new activist investor writes the check and then changes the policy to make sure the project comes online, which is the biggest risk in the mining sector, is actually getting something built, getting through permitting, right, in the West. And so this is a shift in favor of the metals sector. We might not like where it came from, but it's happening regardless, and there is some upside included in it. That's kind of my take on that at present.
A really interesting take with, of course, multiple angles to take there. Perhaps this also fits into a thesis of a commodity supercycle, where you would have a long-term trend upwards for a lot of different commodities due to that underinvestment in mining that you outlined earlier, but now also the US government taking an active stake in this industry and supplying it with the capital it has been starved of.
100%. Yeah, I mean, we've talked about gold a lot, but it's been hard commodities in general that have been incredibly starved of capital. And just more importantly, demonized, because in the West, and it's Europe, Canada, the United States, we decided that we wanted this amazing technology. Like, we wanted all the upside. We wanted the efficiency and the convenience. We wanted it to be cheap, and we wanted to design these products at home so we could control the interface and the applications. But there was a very specific part of the supply chain that we didn't want, and that was the extraction and refinement of these metals. And when China raised their hand and said, we will take that on, we will cede environmental considerations, leverage our cheap labor so you can have your cheap iPhone, it was a great deal for all of us. We all signed that contract. And today everyone's like, we were shortchanged. This was unfair business practice. It's like, no. We voted for it. We did, right? There was a time where this is good for everybody and we all benefited, right? But now that deal is a bit sour. We don't like it as much, and so we're trying to adjust. But yes, that sort of commodity supercycle thesis is on the heels of massive starvation of capital over the last 15 years. So we are short supply on everything. And, no commodity really tells this story as effectively as copper does. You can look at the copper supply and demand fundamentals for like 50 years. You can go back to 1970. And what you'll see is that we increase our copper demand globally by about 4 to 6 million metric tons per decade, right? With amazing consistency. And supply met that demand in 1970, 1980, like right on the nose, 1990, 2000, 2010, a little gap opened up. 2015, it got larger. 2020, now it's a bit of an alligator mouth. There's a big gap between the copper we need, and the copper we can supply ourselves with because we stopped funding new projects in about 2010, right? We just stopped putting capital that direction. And copper mines take about 20 years to come online. So now we're in the midst of this gap. The reason I like the copper story is because it's, Dr. Copper, it's a signal of economic health, and it does, to a degree, take front page in the commodity supercycle narrative. And when people think about copper forecasts, they usually go one of two directions. They either say, well, copper demand is going to skyrocket because AI data centers, electrification, renewable power, all this stuff is going to put unprecedented demand on copper. And then the copper bears will come out and say, yes, eventually, but we might be staring in the face some kind of globally coordinated recession here. And if that occurs, demand is going to get crushed. We're not going to need any of it for a while, right? Both of those sound logical on paper, which is why it's helpful to look at the last 50 years of that decade over decade demand growth, because inside of that 50 years, we saw everything that might happen in the next 10, 20 years. We saw massive technology disruption and innovation. We saw the adoption of personal computers, iPhones, the internet, like all of this stuff just happened, right, in the last 50 years. Yet what happened to the decade over decade demand? It was consistent. It was consistent every decade. We also saw, by the way, a couple globally coordinated recessions. So we saw that too. So that just gives me conviction in the long-term copper outlook, regardless of who's right. I think both are probably right. We're going to see a globally coordinated recession. We're going to see all sorts of innovative demand putting pressure, but we're going to grow at a similar speed. The problem is we don't have the stuff, and that's fixed by high prices in the short term, right? But that story, you can parallel that. I mean, pick your commodity right now, and we could have a similar conversation about it. Nickel's a bit of an outlier, but that's a unique case. And I think that's got like a 5-year sort of turnaround story, but it's a very specific, Indonesian oversupply, cheap labor. I spent about half my life in Indonesia, and, they've conquered the nickel market incredibly effectively, to the tune of like 65% of refined nickel, 67% now comes from Indo, which is a lot. I mean, at its peak, OPEC only had 55% of the oil market in 1955. So 67% of nickel is like the whole thing. And that's going to climb because they're producing so cheap that most Canadian and Australian nickel miners are on care and maintenance. They just can't, frankly, compete. But what's happening as a consequence in the South Sulawesi Islands in Indonesia is probably the absolute worst environmental disaster of my lifetime that nobody is talking about. But eventually we're going to talk about it. Indonesia's modernizing. China's trying to modernize their practices and meet the West to some degree from an environmental standards case. China funded Indonesia's nickel sector, obviously. That's that tie-in. But that current situation is not sustainable in Indonesia. It will change. It's not going to change this year or next, but I think inside of 3 to 5, nickel has a massive turnaround story as well.
Jay, I would love to dive into the framework through which you look at the world. Is it an East versus West framework? Is it a United States versus China framework? BRICS versus the United States? What is the framework that you use to look at these conflicts and this competition, as you called it?
I have 2 filters, Stijn, to review any headline or development that hits our desk. Because, every day we are hit with a new hyperbolic, sensational headline about something big that's changed, some announcement. Usually it's just something some politician said, right? And markets respond. I I find it useful to have a filter with which to view those things through. The first one is through the filter of supply and demand. So back to that, right? We're watching these regional conflicts. We're watching this trade aggression, import taxes, export restrictions, sanctions, all of this stuff. If you're able to step back and view these through the lens of supply and demand, who's got what, who needs what, a lot of this makes a lot more sense. That explains this trend of state capitalism. United States is fiercely trying to regain supply of critical metals. This explains the extension of the critical metals list. This explains the resource deal in the Ukraine. This explains a lot of the conflicts around the world, and always has. You know, you look back through historic conflicts, it always comes down to something in the ground that somebody else wants, right? This goes back to the days of maritime conquest. Like, it's never changed. We always battle over stuff. You know, what's interesting about that is that, you know, we had some conversations at my conference last year about whether or not we'd see nickel wars and copper wars in the future, right? And I pray that we will not, right? And it seems very far-fetched. Why would we do that? But when you look through the history of resources and conflict, you will find that we went to war over cinnamon. You know, we went to war over nutmeg, mace, and pepper. The United States went to war over bananas at the beginning of the 19th century in the Caribbean. Tens of thousands of people died for bananas to protect the interest of the United Fruit Company. We will go to war for the craziest resources. Given a long enough time, the price of any commodity eventually goes to zero or close, right? Like, what used to be valuable becomes cheap because we innovate forward. And that will happen to copper, by the way. Like, high conviction, maybe not in my lifetime, but maybe we will see a commodity as valuable and indispensable as copper become engineered to a place of less value. And people may be like, no way, copper's copper. And I get it. And I'm like long bullish copper, don't get me wrong, and very exposed to that metal. But, you know, it's used as a conductor for electricity. It's actually not the most conductive metal we could use. Silver does a much better job, much more efficient than copper. But it's just, you'd go broke trying to wire your house with silver. It would never work from an economic standpoint. But copper is also not the cheapest, right? You could wire a house with aluminum, actually, but it gets incredibly hot. It's such a fire risk that it's actually illegal in most states in the United States. But we use copper because it's the best present choice. Eventually, we'll find a better one, and the price of copper will drop. But anyways, first litmus test is always supply and demand. I went down a tangent there, Stijn. I'm sorry, man. And the second is, yes, through the lens of competitiveness between the United States and China. And I don't want to like have people jump or to the conclusion that that means hot conflict, that means hostility and war. That's not necessarily what that means. It's not off the table, but I think it's quite far off the table, actually. And we can talk about why the whole idea of a hot war between the United States and China is a bit of a non-starter, mainly because the United States requires like Chinese ingredients for about 97% of their advanced weaponry. So, you know, if you got a gun pointed at me, I'm not going to sell you the bullets. But, you know, be that as it may, those two filters, supply and demand of resources, US-China competitiveness, economic competitiveness, those are my two filters.
Well understood. And when we're talking about the competitiveness, of course, the United States is still incredibly dominant in the financial space. China, like you outlined on the critical minerals and just commodities in general, their supply chain internally, domestically, 90% of tungsten comes from China, I believe. However, even non-domestically, internationally, it's incredible how many mines across the world are being operated by the Chinese.
Yeah, well, that's $1 trillion invested since 2013, right? That's the Belt and Road Initiative. It was China's response to 2008 when their two biggest consumers, being Europe and the US, stopped buying as many Chinese goods because they were on life support, economic life support after the GFC. And one strategy China had post-2008 began in 2013, and this was to fund and elevate the next generation of emerging market consumers by building the infrastructure that would allow them to participate in the global economy. And that was $1 trillion allocated from 2013 for about the next 10 years. A lot of that, I think, was sort of, you know, it's like any investment. A lot of it did not materialize. A lot of the infrastructure did not last. But, you know, other than Sri Lanka, all those loans are in good standing. But as a consequence, you know, China has taken ownership or control over key resources in countries all over the world. You know, we talked about Indonesian nickel, 66% of the nickel market That was built with a $65 billion loan from China, exactly what you're talking about. Indonesia used to export a lot of raw nickel. It's cheap. It's not a good business, but they didn't have the technology or the capital to build the refining capacity in country. Indonesia actually proposed a sort of nickel cartel, like an OPEC for nickel, to Australia and Canada, and Australia and Canada shut them down. So China financed the build in Indonesia. They did it on their own with Chinese capital. And so, yeah, Indonesia is the world's largest refined nickel producer, but they're sort of a proxy for Chinese interests, right? In that situation, yes, copy and paste all over the globe.
Yeah, it's incredibly interesting. And, there's an argument that the United States dollar, it was backed by gold at some point. The last 50 years, it might have been backed by oil. Now we're seeing, of course, Saudi Arabia, joining the BRICS settlement system, or at least seeming to be on the cusp of joining that settlement system. And other commodities are, of course, also now slowly but surely no longer being traded in the United States dollar.
Yeah, again and again. And Saudi Arabia is a very interesting one because as every other country views their current standing in the globe through the lens of US-China competitiveness, countries are trying to figure out how to thread the needle, right? Nobody wants to have to pick a side. I mean, heaven forbid you pick the wrong team, right, in this standoff. And so there's some countries like Canada that don't really have a choice. Canada shares the longest land border in the world with the United States. And quite frankly, it's a great situation. The United States is the world's wealthiest and hungriest customer, and Canada is a breadbasket of resources. So it's a great marriage, and over $2 billion of products every day crosses that border as a consequence. Now, Prime Minister Carney is planning to double non-US exports over the next 5 years, I believe, which is a good policy, right? It's also got the longest coastline in the world, Canada, with access to every international market, but it's never going to be as cost effective to just ship to the US. That's always going to be the best option. But there's many countries that are able to thread that needle. Australia is one that I'm watching right now. Saudi Arabia, obviously another, incredibly wealthy, very powerful. And even though the petrodollar era was sort of over technically for a minute now, after the Israeli bombing in Qatar, when they bombed Doha a few months ago, that event made a lot of headlines, and a lot of people watched that, had a response to it. People were curious why the United States did not offer any recourse because they're sort of the strategic partner in the situation. But the event that happened right after that did not get any press coverage or very little was Saudi Arabia's response to that. A Qatari national has never been bombed inside the country until that event. It was a big deal in the Middle East. Didn't get the same coverage over here, how significant this was. And you have to keep in mind, it was only 6 months ago that the only news Americans were hearing about Qatar was that they were gifting Donald Trump a $400 million airplane. This is like, we're best friends. We just did this big Middle East tour. Qatar is going to invest in the U.S. economy. We're paying it back. Like this is a new marriage between the USA and Qatar. And then this happens, right? And it's a massive blow to trust and confidence. And that's one thing. But Saudi Arabia's response shortly thereafter was to ask the same question: is our partnership and friendship and strategic interests with the United States can we be as confident in that as we thought we could, right? Just like countries are asking, can we be as confident in our treasuries as we used to be, right? And what Saudi Arabia signed shortly thereafter was a defense pact with Pakistan. Pakistan being the only Muslim majority nuclear armed country in the world, and they got that technology from China, which sort of puts Saudi Arabia under the nuclear umbrella of China. The material news there is that although the petrodollar era, has technically been over, practically it hasn't. We could still have made the assumption that Saudi Arabia was under the defense umbrella of the United States. It's no longer. This is really big. This is a country that has the power to stay neutral, and they still are, but less than they used to, right? This is very material. And Pakistan has since opened the door to anybody else and said, this defense pact agreement, by the way, is open to anybody who wants to discuss it, which of course is China speaking through a proxy, being Pakistan, because China doesn't want to say that publicly, but they can say it through a proxy, right? So they're saying it through a proxy. But that's a big one. And Australia, same thing. They're militarily aligned with the West, but economically far more tied to the East, right? From a proximity standpoint, China's a better trading partner. For the same reason US to Canada makes sense, Australia from a global standpoint is more situated towards Southeast Asia, the South China Sea and China. And so, when all this rare earth headlines began at the end of October, or the end of September. It was like all anybody could talk about. China is extending the rare earth restrictions to the US, all this stuff. But China made another announcement that same week that didn't get nearly as much press coverage. And this was them halting future contracts of iron ore purchases from BHP. And China imports like $75 billion worth of iron ore from BHP every year because China is the world's #1 steel manufacturer. That's what iron ore is used for. Now, they didn't halt future orders, just future orders in US dollars. And when your biggest customer comes to the table with a demand like that, and people could say, oh, China was obviously bluffing. They can't afford to stop buying iron ore. This would crush their economy. And that is true, except people don't understand how the state dictates direction in China. It's still that centralized. And when the state says we're halting orders, the corporations, they halt orders, right? And they will withstand that pain until they get approval because the consequences are dire, right? You might get Jack Mod and disappear for 6 months. So nobody wants that. And so this brought BHP to the table. They renegotiated, and moving forward, China can now purchase iron ore 70% in US dollars, but they get to buy 30% in renminbi. So they're forcing more de-dollarization around the world. The reason this one is big is because it's not a deal between China and a smaller Southeast Asian country like Indonesia or Vietnam. It's not a BRICS country like Brazil or India. BHP is Australian, right? Part of they're like a G7 adjacent country. And a couple things happen as a consequence of this. Number one, it's precedent. It always comes back to precedence. When an event like this happens, you have to think, what's this precedent for? What part of a trajectory is this? And this is now a point of leverage that China can take to the rest of the world. And they can say, look, we now do business in renminbi when we want to. And it was good enough for BHP in Australia. So it's going to be good enough for you because I guarantee you're smaller than BHP, whoever they're talking to. And that's true, right? And and countries will feel more comfortable accepting those terms because they didn't have to go first, right? It's always easier to go second and third and fourth. And secondly, BHP now will be accumulating a treasury of renminbi. So what are they going to do with that? They could convert it to US dollars and maintain business as usual. But as any non-US business owner knows, currency risk is an absolute headache. It's expensive. It's risky. And so converting that renminbi to US dollars is not optimal. What they'd rather do is just find a home for it, a supplier who will accept renminbi. The obvious one is China, but outside of that, BHP is now incentivized to see other multinationals and countries de-dollarize and accept their renminbi so that treasury has utility, right? And that's a big shift as well. So, that's two major developments that didn't get a lot of coverage, but they speak to exactly what you're talking about, is that there's a shifting of alliances, not just to the United States from a military standpoint, but obviously from a dollar trade standpoint as well.
Incredibly interesting developments, that's for sure. How could the US potentially shift the tide? Of course, we're talking about China, authoritarian. Externalities are there included. They are taking costs into account that are being carried by the whole country, not just by a company. The United States has a bit more of a problem due to that free market nature. What can the US possibly do to try to get ahead in this competition?
Well, I think they're trying to do it. They're trying to reshore jobs, bring control back home. When you hear bring steel back to Pittsburgh, bring middle class, all they're talking about is control. We lost control of a lot of our economic inputs, and we need to regain control of those. And by the way, one we're not hearing a lot about yet, but I think we probably will, is pharmaceuticals. To date, the headlines of the trade war has been China's got control of the mining and refining of critical metals. Well, they've got just as much control over the United States pharmaceutical industry, and that hasn't come up yet. But if I were to lay a prediction out today, it's that we're going to see that headline, and it's going to be incredibly disruptive. But in the meantime, the U.S. is hard at work. I mean, these equity deals we talked about, that's them trying to rebuild American industry. The problem that they're going to run into with this thing is that, China industrialized over the last 30 years. That's when they built their country into this collection of specialized economic zones for, AI, for renewable power, for vehicles, for pharmaceuticals, for everything else. And they built very intelligently. The refineries are built right beside the component makers, built right beside the heavy rail or deep water ports. Everything was very streamlined to maximize efficiency and reduce cost. The United States is now going to attempt a version of that back home, to reshore their manufacturing might. It cost China about $41 trillion to do that over the last 30 years. So what's the price tag going to be in today's dollars? And it's a really important question because the United States is going to have to create that money from nothing. That money will be printed. If they're serious, and I think they absolutely are, about reshoring these industries, it is a price tag. It's like remodeling your house, right? You think about all the new features you want. You've lived in this house for 20 years. It's getting a bit tired. I want to put a sauna in the backyard. I want to redo the bathroom. Our kitchen needs to be blown up and just bigger, like all this stuff. Then you have an expense sheet and you look at the budget and you decide what can we afford to do, right? Well, that's the exercise that nobody seems to be doing with this reshoring exercise, but it's the exact same thing. It's a remodel on the US economy. It's going to be amazingly expensive. As anybody who's ever done a remodel knows, it costs way more than you thought it was going to, right? Along the way, you just get slayed by unexpected costs or inflated prices. And that's the situation that the United States is trying to reshore into. It is going to be tens, if not more than tens of trillions of dollars to reshore this. That money is going to have to be created. The inflationary impact of this, I think, is potentially going to be one of the craziest phenomena that we've ever seen over the next 10 years. And that's the only way I can see this getting done. It's not, this narrative is not being talked about, but I think it's very significant. But that is the strategy. That is the strategy. It's United States looking internally at how can they finance the rebuild of these industries and incentivizing their partners to do the same. The Canadian budget came out a month ago, two weeks ago maybe, running an $80 billion deficit. I remember when Justin Trudeau was first elected, and one of his first decisions was to announce the new budget, and there was a $10 billion deficit, and Canada lost their mind, right? We had one of the most fiscally responsible leaders ever, in the previous 10 years being Prime Minister Harper. And then we elected this haircut, and his first decision was to run a $10 billion deficit, and people lost it. Mark Carney just took the helm, and his budget was announced with an $80 billion deficit. And it's almost like no one batted an eye. This is just the new normal. But, Canada's going through the same exercise, right? And so we're going to see similar incentives pressed upon all American allies. But that's the policy, man, is can the U.S. keep their allies close? Can we reshore industries within the country and next to Canada, U.S., and, Mexico and adjacent countries, and regain enough control to be competitive without completely blowing up our balance sheet? I don't know the answer to that question, but I think they're going to try.
And of course, knowing that that's coming makes commodities even more attractive today. I would love to switch to Venezuela for a second. Perhaps you can unpack who is involved in that conflict, what the incentives are, and perhaps how this could unfold itself.
I tend to think about this American administration as they've shown us time and time again that they're extraordinarily good at the head fake. The Kansas City shuffle, I'll make you look left and I'll go right. And so although everybody's talking about the immediate invasion that might occur in Venezuela and the regime change goals and targets, if I'm being really critical, I just think that's not the game that's being played here, right? That's the obvious one that we can see right in front of us. So what's the real motive, right? What's really occurring? What's the real strategy here? The short answer is I don't know. I had a geopolitical analyst on my show just last week, George Friedman, who talked about another underserved development that was the renewal of a defense pact between Cuba and Russia. And this would allow more missiles, ballistic missiles, to be placed on the island of Cuba, which puts mainland America at direct strike risk in the midst of what is already a increasingly tense Cold War bridging on hot. And that would be completely unacceptable. So the reason that the Caribbean is being flooded with aircraft carriers, F-35s, B-52 bombers, and Reaper drones right now is not because of Venezuela. It's just a very convenient smokescreen. I mean, we know at least the narrative we're hearing about doesn't hold water. The current American administration has reused the drug narrative enough times now, right? Like initially that was the reason we're starting a trade war with Canada, was because of all the fentanyl. And it turns out like almost no fentanyl comes from Canada, you know? We're seeing this with China now. China's agreed to curb or get serious about policing fentanyl production. But fentanyl production happens in Myanmar. The ingredients sometimes come from China. They're smuggled across the border into Myanmar, which has become an incredibly lawless country. And that's where it happens. So what's China's actual capacity or incentive to get involved in the drug trade in Myanmar? Like it's not really high, right? So it's just smoke and mirrors. It doesn't actually hold water. Makes for a great headline. People can celebrate it, you know, but it doesn't actually do anything, right? And Venezuela is very similar. This is not the focal point of either cocaine or fentanyl, and the trading routes don't happen on that side of the continent, right? The drugs that come to America, they come up the Pacific. And you know, if this is a sort of jump off point from Venezuela to Europe, that doesn't really explain the American military intervention. So you know, you could say it's that, and maybe I'm dead wrong. You could say, well, they have the largest oil reserves on the planet, and that's all we need to know. Back to what's beneath the surface. This will tell us the truth often, and it could be that simple. Although Maduro has expressed a willingness to do any kind of resource deal that America wants, and that's just fallen on deaf ears. So it's a bit curious. I think it's worth paying attention to what else is happening in the region and thinking what else might this activity be there for. And it could be that Russia-Cuba defense pact renewal. So it's a developing one. My only confidence in that situation staying is that what we're being told is not the real motive. That's for sure.
Not the real motive. I definitely got that. Of course, now that we're talking about Russia for a second, what is interesting is putting that into context of the previous competition that we're talking about between the US and China. Russia, where does that play into it? Is it a partner of China in this grander competition, or is it a separate player altogether?
I think Russia is, like many countries around the world, trying to maintain their neutrality, but also pick the right partner. And they've been forced into one corner. Russia is like the clearest example from my standpoint of, you know, this analogy that we used on our show a couple of times about the hammer and the anvil, right? If you look at a hammer forming an object on top of an anvil, the hammer's doing all the swinging. It's working really hard, right? But as we know, it's the anvil that shapes the object. It's the stillness, the patience, and the strength of the anvil that shapes whatever the object is. And the hammer cracks way before the anvil does, right? It's got more staying power. The more aggression we see coming out of the United States towards any nation, and Russia is a classic example, it just forces that part of the world to form around the anvil, which in this case is China. The United States is the hammer parading around the globe with trade restrictions, sanctions, and more, swinging wildly, look like they're doing all the work, but the rest of the world is quietly forming around that anvil. And when you know, Russian gas flows were cut off to Europe, that energy didn't halt or disappear. It just started flowing east. It flowed toward the anvil. You could see the same thing in Iran. When Iran, with the second or third largest oil and gas reserves, was sanctioned and exiled from the global economy, the energy didn't disappear. It just began flowing up to the anvil in the dark fleet to China's teapot refineries and so forth. And so, you know, Russia's been pushed to become a partner of China. You know, you could debate all day long if that's what they wanted 10 years ago. There seemed to be the opposite motive coming from Putin, but there was no reception coming from the West. I think if you look at the history of Russia, a lot of the border conflicts, they just make more sense. Russia's got no natural boundaries. It's not like the United States. The stopping power of water is very real. The US has never been invaded as a consequence, except for when the Europeans did. But in modern times, this is not a realistic project for any adversary to attempt to take over the US or invade by sea. The stopping power of water is very real. That's why Canada is very secure. US is very secure. That's not the case in Russia. And it was those borderlands and the vast amount of territory that stopped Napoleon in his tracks, that stopped Hitler in his tracks. Without that, the story of Russia would have been very different. In the West, we may not be familiar with that history, so we don't understand the aggression on the borders, but in Russia, they absolutely do. This is recent history. The Patriotic War, as World War II is called in Russia, was saved largely due to those borderlands. And so NATO creep isn't like passive whatsoever. It's incredibly hostile and dangerous, right? And so the response, maybe not justifiable, the invasion of Ukraine, was far from unprovoked, far from unprovoked. And so Russia, I think, was a country that was trying to straddle neutrality for a long time. You know, it's the largest commodity exporter in the world. They've got a ton of potential. Logistically, it's an impossible country to manage. If you look at the direction and the flows of the rivers and the land, it's just very hard to transport and navigate. The United States has an incredibly complementary river system, and that's why their trade economy grew so quickly. Russia's the opposite. It's a very tough country to manage. So from a geographic standpoint, it's just a bit of a messier project. But I think they've been forced into the corner they're in, and I don't see them coming out. I think this is more of the world forming around the anvil, and Russia's a big piece of that. And what a blessing to China. The world's largest commodity exporter is forced into your corner and doesn't have the option of a global market, so they'll sell to you for a discount. And that's Iran's story. They sell over 50% of China's oil comes from Iran at a steep discount to global prices because the hammer went swinging wildly around the world and pushed them towards the anvil.
Yeah, I was going to say, you could almost make the argument that this hammer and anvil analogy also has caused BRICS to be created by the West almost. If you look at the constituents, they're unlikely partners and sometimes even unwilling partners.
Ideologically opposite in many cases. You're absolutely right. It's like they're unified by one thing, and that thing is to, overthrow the US dollar or at least gain some freedom from it, build some optionality into the global marketplace. Aside from that, you're absolutely right. They're culturally, politically, religiously different from each other. And so I don't think that organization actually has a lot of staying power over the long term. It will fracture and fall apart. But in the meantime, there is one unifying goal that binds them together. And if you look at the applications of BRICS Plus now, like what are we at, like 30 countries? Like it's not a small number of nations. It's a big percent of the globe. And that can last, it's not a direct parallel, but you think about United States allying with the Soviet Union to overthrow Nazi Germany, right? Two ideological opposite partners, but united behind one central goal. But as soon as that one central goal was accomplished, we landed in the Cold War because turns out these two countries were natural adversaries. There was just one thing temporarily that bound them together. And as soon as that one thing was no longer a threat, everything else came to the surface. And I think BRICS will probably go through a similar experience through the course of increased de-dollarization around the globe. Once enough optionality is built in, we'll see these relationships become less strong than they used to be.
Do you think that BRICS settlement currency that we hear a lot about, potentially up to 40% backed by gold, the other percentages backed by the local currencies, could play a big role in that de-dollarization trend that you're outlining here?
Yeah, I think so. I think all options are on the table right now. And, we're seeing an interesting answer from the United States with the Genius Act and the Stablecoin Initiative, trying to force digitally re-dollarization of consumers all over the world who are, invested in the crypto sector and need a centralized settlement currency, being the stablecoin that is now backed in theory 1-to-1 by US dollars. It's a really interesting moment in history where we're seeing a lot of initiatives to find backdoor routes to global trade. And, I don't know about a BRICS. Again, I think the idea is enough to put pressure and cause change, but I don't think where we land is in some kind of, BRICS unified settlement currency. I don't think that's where we go. I think it's far more likely we end up in a situation of multi-polarity where there's like 2 or 3 main transaction vehicles that the globe is now leveraging if and when efficient. So, yeah.
Incredibly interesting, Jay. I'm sure you've seen the clips on X being shared about Mexico. There seems to be an uprising in the country. Perhaps you could outline who that is and what they're uprising against.
To be honest, Stijn, I cannot shed any light on that one.
Interesting. You've missed that one.
Yeah, it's not on my radar at present. But you catch me up. What do you know about what's happening in Mexico right now?
Honestly, it seems to be a very complex situation there. It seems to be an uprising in the younger population against the current government. I was willing to listen to your take there, but perhaps we can then transition to the Vancouver Resources Investment Conference that's upcoming in January.
Yeah, let's talk about Mexico next week. I'll do my homework. But yeah, so we have a conference coming up, Stijn, for anybody who is interested in investing in the mining sector. It's my annual event every January in Vancouver, British Columbia. This year, I expect around 9,000 investors to attend. We fly in around 120 keynote speakers. So anybody from the industry who has been allocating capital effectively, I want them on the podium sharing their best ideas for 2026 and the incoming years. A lot of very familiar names from, the Robert Kiyosaki's, the Andy Schekmans, Rick Rules, Grant Williams, Nomi Prinz, Danielle DiMartino Booth. A lot of faces that people know from your show, my show, and our peers. But I try to do my best at finding the, off-radar investors who are just killing it. And they're finding opportunities before anybody else. And they're not public personalities, but they're making tons of dough and great deal flow. And so, out of the 120, you'll see about maybe 30% are the bigger macro names because people always want to hear from them. And I organize very exciting debates and panels with those individuals. But we also have a lot of people on stage who are only there to talk about capital allocation into the mining sector. Here's my strategy to make money in the industry next year. And, people come to hear that, right? And it's 2 days. It's tons of fun. VRICmedia.com, January 25th and 26th in Vancouver. Would love to see you there, 100%.
We'll be there actually, and I would love for you to take a few minutes talking about the Commodity University as well.
Okay, so the Commodity University is a project that we launched after 100 conversations at the Vancouver Resource Investment Conference. I saw many new investors show up to our industry over the last 3 years. And many were not new investors, but they were new to mining and metals. And I had the same conversation 100 times. It was somebody who was like, I feel like I'm in the right place. I feel like this is the industry that I should be looking at, but I don't have a clue what's going on. I don't know how to talk to any of those CEOs. There's 300 mining companies exhibiting in your trade show. I don't know how to interview them. I understand about 20% of the content from the podium. How do I get started here? How do I get started? And as you know, Stijn, there's 100 answers to that question. How do you get started as a mining investor, depending on your available capital, your risk tolerance, your time horizon? So we built an online education platform for that investor. And we started with one course called Commodities 101. I was like, I want to arm every one of these individuals with the intelligence to show up at my conference and be able to have an intelligent conversation about any hard commodity. We're talking gold, silver, copper, nickel, uranium, and energy metals. That's where we started. I want you to consume this course, come back to my conference, and you can talk to anybody about those subjects, right? You have the confidence to learn more because you're not scared to ask a question that you think is dumb anymore. You probably know more than most people at this point. So that course ended up being a tremendous success. And so we've since scaled the platform. We've now got 11 instructors, many personalities from the junior mining sector that visit your show, and they are sharing what they're best at, right? Adrian Day gives an absolute masterclass in the royalty and streaming industry, how to pick winners, how to get the nose off your desk. Lobo Tigre gives a masterclass in geology for mining investors for non-geologists. And he just demystifies all the terminology that companies sometimes intentionally put in their press releases to gloss over results that aren't that good, really, and he helps you just cut through that noise and get to what really matters. And 11 instructors who are doing the same thing. So there's a new course drop every month. And we have a mastermind every month as well, where the students gather and myself and a few of the instructors just field questions. And we spend about 2 hours just running through a bit of sort of like shop talk, what's happening in the sector, sentiment, are you allocating capital? If so, where? And then the participants, the members of the Commodity University, bring their deals to the panel. And we do this, we don't publish it, so you can talk about whatever you want. It's all private. And the panel will share their very honest opinion of what they think about the companies that the members are investing in or looking at. So thecommodityuniversity.com, check that out. It's tons of fun. This is a tough industry. It's very volatile. It's very risky. Don't go it alone. You don't have to. You could join a community where you can share your ideas with a bunch of peers on the forum and at the monthly mastermind, and every single month consume a new course that will build your competitive advantage. Most people don't do this. They show up and they buy a stock because they read a promotion, like an advertorial, and they thought it was research, or a buddy told them about a company. That's the majority of research most people do. You consume content like this, your competitive advantage puts you leagues ahead of the marketplace. And I love it, man. We built this this is the platform I wish existed when I got into the industry 15 years ago. That was really like the driving force for us. It's like, let's build the resource that wasn't there that we wish we had. So, yeah.
You sound incredibly enthusiastic. We'll definitely put the links in the description. And Jay, thank you so much for your time and your insights today. Tremendously appreciate it.
Stijn, pleasure's all mine. I appreciate this.
Awesome. This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.